So UCO USO. This is the oil video. We're gonna look at the price of oil and look at the funds that are tracking oil and see what's going on. And I've got a trick at the end here that most people probably won't expect, and should be a pretty cool look at how to go long on oil without all of the negative carry. And I'll show you what I mean. So this is Brian Lewis with MMT Investing, and things just changed. So you can see back here, this is a long-term look at just the West Texas crude oil, just prices. And you can see going into the financial crisis, we get an up and a crash, and then we get a lot of up action here, and then a crash, and then a lot of up action here, and then a crash. So oil's kind of doing this sort of downtrend zone right now. Ever since the financial crisis, it's just been kind of working its way down, lower highs, and well, way lower lows. I mean, this bottom here is just something else. When it actually collapsed below below zero relative to the futures contracts, and so we're pretty close. We're not close to like $0 right now, but we're pretty close to the low edge of this range here, right? And people are thinking oil is going to go up, and that may very well happen. So if oil works its way up, probably, I don't know, a good target would be the edge of this range somewhere, and that would be out in a few years. But just a general uptrend in oil right now, possibly if it continues this pattern. But I wanted to look at the funds that are tracking oil and if oil actually looks like it's going up or not on the technicals. And yeah, let's get into the funds, and I'll show you some crazy stuff in here. So here's the USO, the United States Oil Fund, and you can see here it goes up to the crash and crashes, right? But when you get that big up movement in the price of oil, the USO is flat. And this is an ETF for spot contracts of barrels of oil, and so they're futures contracts of actual oil barrels. And in order to, like, when the contract expires, you are getting physical delivery of oil. So people speculating on these futures contracts directly, or on the spot oil contracts, have to actually take delivery of oil. And this fund trades those futures, but every month, and it's coming up again to the middle of the month. Like in the middle of the month, it sells the current contracts and buys the next month contracts. And you can get a long squeeze if the prices of oil are going up. And this is what contango does to a fund like this that rolls future contracts over, is when you're going up, if the future price is higher than where you are now, the current spot contract dives down and you lose value. You sell it low and you buy the next month contract at a normal price, and you lose percentages every month when it rolls over. And it's also a financial product fund that does compounding. So you in the volatility, and every day when the compounding calculates and resets, you lose percentages in the volatility. So mathematically, this thing is just decaying to zero. And what you get is, when the oil price goes up, it's just volatile sideways, and when it crashes, it crashes. And here, let's scroll through and check it out. Pretty reliable. So if we chop that off, you can see the volatile sideways, and then you get the crash, and then at the edge of that crash, you get the volatile sideways, and then you get a crash. So if in fact oil does work its way up, the odds that the USO works its way up are pretty low. Like, it's most likely just going to get a volatile kind of sideways thing until the next crash, whenever that might be. Could be this week, it could be in like 5 years. So that's kind of how the USO looks. And then if we go over to the UCO, which is really popular as well, this one is a 2x levered, and it's an ETN, which is not actual contracts of physical delivery of oil. It's an exchange traded note, which means it's just a debt contract from ProShares. And so you get some counterparty risk because it's not actual contracts of physical oil. And then you get the dramatic 2x effect. And we get a similar thing. This thing started around the financial crisis and got the crash here. And then you see it's more volatile as a 2x, but it's still bounded sideways, crash, and then flat. And let's zoom in on this thing and look at it. Same kind of thing. Volatile sideways, crash. And when it crashes, it just doesn't make it back to the highs. And you get the crash and the crash, right? You chop it off, see? But the highs are here and never makes it back. And you get the volatile sideways, and you get a little crash here, and it never makes it back up. So every time it crashes, you get a good crash that follows the crash, but on the way up, it's just capped. And that's the same thing. It's the future contract derivative rollovers, and it's the compounding math. So these just have a negative carry. That's called a negative carry, and it just decays. And I mean, that could be a really good thing as far as how you want to trade it. If you know it's just going to go sideways and then down, sideways and then down, that makes it easy to trade this thing. And you can try to short it on these down moves, and then it's not too risky to hold it short. But the time length sideways, like if you're doing put options, this sideways activity, it will kill buying puts and calls and stuff like that. So you got to get this down action. So holding normal shorts against this around where you think it might be going down is a good idea. Possibly. This is not investment advice. And so yeah, so that's the UCO and the USO, and they always smash that like button right now. Please to help me out with the YouTube algorithm, and please start a conversation in the chat, and I'll get in there and chat with you guys. And where are we now? So same kind of thing here. Crash, doesn't get back. Crash. And so it's always relative to the previous crash. So the upside, I mean, where is the upside on this thing is maybe around here, halfway or a little more, something like that. Or it could crash in half again from 14 to like 7 and then never make it back up to where it is now, 14. So the upside on the bottom of the crash is capped, and the downside, every time you get downs, it's just hard to get back up. And that's the UCO. And what I wanted to take a look at here is I had a trick kind of with the VIX. I did a video for how to go long on the VIX, but have all the negative carry helping you. And that's what I was trying to do on oil because it's really tricky. And there is the SCO, which is the ultra short 2X crude. And it's an inverse fund. It's a short fund. So when oil is crashing, so you can see here the crash in the financial crisis is a huge peak. And then this whole time when oil is going up here, it's going down. Let's go ahead and put the thing on here and take a look at it. So here's the crude. And you can see that it's pretty good inverse. And it's 2x, so a move from wherever this is, like 12 to 30, it's like a 3x gain. And it makes it look like the fund is less intense than the crude oil prices, but each move relative to the previous price is exponentially moving at the 2x rate. And it does look actually pretty inverse to oil itself here. And I'm not seeing that much of a negative carry because the lows here are similar to the lows here. And we get lower highs every time. And the oil price has been coming down this whole time as well. So a lower high on the oil price is creating the same low. So if it got back up to the same oil price, it should shove this thing down farther. So this is decaying, and you get lower highs the whole time on the peaks, and the lows, if you got higher oil prices, the lows would go lower. So this looks like a good way to track the opposite of oil, right? But if people want to go long oil, this is short. And that's exactly what you want. So you can short the inverse fund. So you're shorting a short fund, and then those negative carry compounding and all of that works in your favor when you short it. So let's get in here and look at where we are right now. So this, if we look at the Bollinger Bands on this thing, let me get the oil price out of here. If you look at the Bollinger Bands, you can see on these kind of flat sections where oil price is going up, it just kind of sticks to the bottom edge of the bands, and that's what you would expect. And then when it's going up, it's just volatile, like poking through, and it does that here, and it pokes through, and then reverses hard, and then sticks to the bottom, right? Reverses hard, and then it sticks to the bottom, sticks to the bottom. And that's what we're getting again, volatile up, and it's blasting through. And now we're kind of in the middle here. So just from looking at this fund, it's hard to detect if it would go up or down from here. But you can see a strategy just looking at the shape of the chart is basically anytime that it explodes up through the top of the Bollinger Bands is a good time to short it. And it'll usually come down at least to halfway or sometimes past. And quite often it goes past halfway on the bands. But no matter if it's uptrend or downtrend in this thing, every time it blasts through the top, it reverses down, and it usually reverses down to the bottom bands. So that's a really cool thing, and we don't have that right now. We missed it. It did that already, and now we're down here. So I would say this band is a good target, downside target here, and an upside target if we can get back through the band. That would be a really great place to short this fund in order to go long on oil. And I was going to mention that the futures contracts and all the contango that's affecting all the oil prices is coming up right now because today's the 14th. The 15th is when they start, those contracts start expiring, and the funds are going to be rolling stuff over. So like from the 15th to the 20th, like the end of this week and out to about Wednesday of next week is when all of that, all the contango rollover craziness might happen again, and it's possible to get another long squeeze. So I mean, last time the oil prices were what, like $12, the actual price of the barrels, but the spot contracts got long squeezed down to like minus 40. So I mean, that was like a $50 swing from the actual price of the barrels just on those contracts because people didn't want physical delivery, and they're holding them till expiration, trying to get a better price, and it wasn't getting better, and then it just collapsed. So the odds that that happens again is a lot lower on this one, but we're still in contango, so you can still get a long squeeze. And the price of oil barrels right now, I forget what the price was. Let's see. It's at 26, 27. So, I mean, a minus 50 long squeeze on that would put it negative again. But, you know, if you got half that, it would put it around zero. So it's possible to get another long squeeze over the next week that does something crazy like that. And if that crashes oil, I mean, these kind of UCO kind of things, if they crash down, they're probably not going to get back up. So I think there's risk over the next week. As far as going long on oil, I don't like going long on oil this week, just because that all the contracts are happening, and maybe shorting is a good idea, and actually shorting oil. But this the short fund, if you short this thing, that's how you go long on oil with at a 2x without getting the negative carry. And then you can see the spots where it's good to short is when it breaks up on these peaks out of the Bollinger Bands, which it's not now, it's in the zone. So it's hard to say if it's going up or down from here. And I think there's risk. And so I don't particularly like any of these trades right now, other than possibly getting some short exposure to the UCO or the USO to see if it does another super negative contract thing, and you could just day trade out of that thing if it collapses sometime over the next week. And it's pretty crazy. They're pretty risky right now. And then I want to take another look. What's this? XOP. This is the oil, gas, and exploration ETF. And these are all of the kind of fracking and exploration companies that are just in super trouble right now. The oil prices are so low that these companies are not profitable, and we're right in the middle of a credit contraction cycle. Where are we in the cycle? Here. So the cycle, I think we're over halfway through this credit contraction cycle, and we got a big rip down at the beginning of the cycle, and these didn't rebound that big, and we should be getting another contraction move down here. And so these companies have bad balance sheets and really bad profitability and ton of debt. And so when you get this credit contraction squeeze, that really hurts. That really hurts all the companies, but especially the ones that have a ton of debt and these ones that are not profitable. So this is I mean, goodness, like most companies have bad profitability and a ton of debt. And so that's why we see these huge moves down in the stock market right now when you get these credit squeezes. So if we are getting another credit squeeze now, which we might be, we're seeing these down moves here. Where is it right now? Okay, so it has gotten back up. This is pretty interesting. It's gotten back up to this, the middle of the Bollinger Band and gotten rejected now. So we'll see if it comes back down here and test the bottom edge of the Bollinger Band again. That might have been a good time to short it right there at reversing off that band. Missed that opportunity while I'm filming the video here, but I do have a little bit of short exposure to this that I did yesterday. And so I think that these ones could get some downside from the oil the next week, like all the oil contracts and everything that's going to come up in the next week. Could be some downside risk, and then downside risk from the credit contraction. So I think this is an interesting kind of thing to actually short here as far as companies that are in the most trouble and have not been asked if they want bailout loans. So these companies are not getting bailouts right now, and the government's going to have to figure out what to do about this. I don't know if the government wants to try to save the fracking industry and nationalize it and run it at a loss, or if, I mean, what do you do with all the oil field equipment if it stays down long term and they're not profitable? And I don't know, if they go out of business, I would imagine the US government would try to nationalize this and just keep producing oil. And so I don't know how that would work for the stocks and everything and the ETFs. What happens to an ETF if the government nationalizes all the companies inside the ETF? I have no idea what happens. Like, they probably would just be buying all the debt off the balance sheet and trying to hold them. I don't know. This is a weird one. I'm not exactly sure if these companies do get in serious trouble, what it looks like. But I think with the ETFs, you kind of get extra downside because the ETF is capable of doing worse than the actual assets inside of the ETF. And I mean, if you know exact companies that you think might go out of business, you can short those, of course. But just as general shorts, the ETFs have been really good general shorts throughout this down cycle. And it looks like we have about another month in this down cycle. And so that's just a short idea that, I mean, the oil prices are not projected to go high enough to make these companies profitable, and the credit contraction is going to hurt them. And they're trying to get some fracking kind of activity back online, but I mean, this looks kind of like an intermediate high that will probably be coming down off of here. And the downside, I don't know. I don't know the downside target on this guy. This is kind of a weak short. I have a little bit of exposure to this, but I'm looking at some tricky kind of oil ideas over the next week. But I want to get into the actual trading screen and look at the SEO and talk about um, actually going long on oil. So if the prices of oil is projected to go up over the next 2 months, which is about what it's supposed to do, go up for a couple months and then it should go down towards the end of the year. That's what the oil price projections and the futures look like now. And so here's the SEO. This is the ultra short. And so to go long on oil, like I'm not trying to buy this week because I think there's a lot of risk this week with all the oil prices. But after the contango period passes and we see where we are, and I think oil will be actually going up for a while, this is a way to go long on oil with a fund that you don't lose that that negative carry. And so it's a short against the short fund. So you're going long and you buy open a put. This is a put option. You buy a put. And if, let's see, it's like June or July maybe would be the peak of the oil price. You don't want this thing to expire around the peak. You want to get a timeline that goes like twice as long. So October would be twice as long as where that oil peak might be. And there are no options for October. Okay. So can't buy options for October right now, I guess. Or it just glitched and there they are. Okay, so here you can see the current price of this fund is up at 38 and you'd expect it to come down. The bottom was around 12, so I mean this thing could come down to around 12 again by that period, but probably around 20, maybe half of this is something to kind of expect. And so to be safe, you can kind of buy options at the money, or if you want to be really aggressive, which I wouldn't want to be that aggressive on this oil price because it doesn't look like it's going to be going up that much. But I mean, you could get, farther in towards a target price if you had one. And you can see the price of buying the options changes dramatically as you get out of the money. And that's because it's a way more risky to buy it out of the money. And that's just because of the structure of the options. You're basically buying insurance against this ultra short crashing. And the oil prices going up is what would crash the ultra short. It's inverse. And so you get paid basically on your insurance policy if you're below the price that you buy the insurance at. So right now we're trading around 38, right? So this is kind of the price. So as the price gets below 38 in the fund, you would start getting paid out on your insurance policy basically. And you could exercise the option and you could actually get the money, but nobody actually does that. What you do is you just sell the contract to someone else once it gets closer to the price that you want. So, I mean, if you really think it's going to 20, you could get in here and you can see the prices. I mean, they swing down dramatically, and like this is a bad price, but this is a good price. Like that one right there looks really good if you can get that one. But there's tons of action here, so this will be really easy to trade. But you can see this is just like individual people trading these contracts, and sometimes you see a contract that is cheaper than it should be relative to the prices around it, like this one. And so that would be a cool one to just buy it. And I'll show you that you probably can't get it right now because as soon as it refreshes, someone else probably already bought it. Yeah. Oh, no, it's still there, 530. So I don't want to actually buy this thing right now because I don't want to go long on oil today, right before all the contracts are going to roll over and everything like that. But, you can go whatever market or limit. This is a big spread between the prices. Usually those prices are way closer together. Okay, so that's it. Yeah, we're just we're buying it at 25, and so the insurance policy would basically start paying out once you get lower than 25. But if you're higher than 25 or lower than 25, you can trade this contract to somebody else. Like if you've bought it here and it gets down to 30 and you're still a little bit out of the money, you can just trade that contract to someone else anyway. And the time length is really important. So that's why if you wanted to trade this thing over the next month and a half, you get the option that's a longer time length than the entire window that you want to trade it, because as the time passes, you lose value on the policy basically. So just for a price estimate here, if we're buying this one, see it says 530, but the actual price of buying the insurance is 530 because it's 100 shares. And you can see here T100, it's 100 shares. So you're buying insurance at this price per share for 100 shares. And so it's 530 for the insurance price, but then you're controlling 100 shares of this stock, which is trading at this price, right? So add 2 zeros to that, it's $3,800 worth of shares of this thing. So for $500, you can control, whatever it is, $3,800 worth of stock. So if it swings from 38 to half that price, like you basically get to keep that amount, plus you can sell the contract to someone else and get a bunch of the insurance money back. So that's the idea of trading options and going long on a short fund, shorting a short fund in order to have a long position with put options. And then all of the compounding and the negative carry is actually helping you. It's on your side. And that is kind of how you can buy. You can kind of get a deal on the option. Sometimes if you dig around and there's just one that's cheaper than it should be, you can buy it. There's usually not a stack of like 300 that are cheaper than there should be, but sometimes there's one and sometimes you can get it. And so just trading the option, like this one at 530, like if you could buy this one right now, you could turn around and put it right back up for like 7 or something, and you could immediately make money in like 10 minutes just buying it cheap because it's there and then reselling it without this changing at all. So that's kind of how options work. They're contracts that you're trading, and they're like insurance contracts, and they have timelines, and it's really, really important. Like if you short this thing, you want that price to go down right now, because the more time that passes before it goes down, you're losing money that whole time. And as it goes out farther, like towards the end of the contract, it really loses value as you get towards the end of the contract, because it really turns into an insurance policy where you have to exercise it. And if you're not below the price, then it's worth 0. And if you're just a little below the price, it's not worth very much. And you have to be significantly below the price that you bought the insurance on to get a payout. So that's why the risk is really high, and that's why the insurance is cheap. If you go to a price that's dumb, the insurance is cheap because it probably won't get there. Plus, you have to get past that price to actually get paid on the insurance. So the person selling the insurance is just like, okay, well, I'll take a little bit of money because that's not going to happen. But if you know how these funds are structured and you can see downside that the person selling the insurance doesn't see, you can kind of take advantage of the shape of the funds here. And so going back to this SCO fund here, if you're up here in crazy land where it looks like it's going to reverse hard out to the bottom edge of the Bollinger Bands down here around 12, you could go from 60 to 12 if you could get a short at these prices. I mean, you're looking at it going way less than half. And you could go get insurance for pennies, and you could get a huge payout, a 10x or 100x on the policy or something like that, and you could just make a ton of money. And you get the pattern here. You can see where to short it. It almost never breaks out of the bottom. It sticks to the bottom when oil prices are stable and going up, and then during crashes it starts poking out of the top and reversing. And this thing looks pretty easy to trade, and it's not, and we missed it the last month or the last couple of weeks. It was up here at the spot where you'd want to do that, and it came down here to the spot where you'd want to trade it around the middle of the band. And once again here, it's reversed, and we don't know if we're going to bounce off the band or if we're going to get down to the bottom edge here. But those are the downside targets, would be to the band or to the bottom edge. And if it does get back up here out of the top, this is a killer short. So, and once again, it's a short, but you're shorting a short fund, so you're going long oil. And this is a really tricky way to go long oil. That's really interesting, and I've been trying to figure out ways to do it without getting all the negative carry, or just trying to trade the spot price of oil is pretty boring if it's just going to go up from whatever it is now, 26 up to 32 or something over the next month. I mean, this thing could go from 60 to 20 in the same amount of time that the crude price goes up $10 or something, just because it's crazy. And so that's a cool thing. And then I guess I should talk about the oil tankers in this video. So please hit the like button and the subscribe thing. There's a subscribe little thing over here somewhere. I think there should be. And please start a chat in the comments. We'll get in there and chat with everyone. But yeah, just talk about the tankers a minute. So we have our crude tankers, which is, so this oil oversupply has made all the tankers, instead of transporting oil around the world, the tankers are just being used to store crude oil. And so you have the crude oil tankers like DHT, double hull tankers, and there's the Nordic American Tankers, NAT, and like TNK, Teekay Tankers is crude. And then Frontline, FRO is a bunch of crude tankers. Those are big crude fleets, and those ones are being used to store a ton of crude oversupply. And so this is a good way to kind of go long on the oil situation in general, because these companies are really profitable during this oil contraction, whatever. So right now, over the next week, when we see if oil is going to do another contango kind of down move, and we'll see if this credit contraction happens over the next week or two. It looks like it's on right now, and that should pull these companies down, these tanker companies down, and the oil price crashing. If we can get another low spot on these tankers to get in, these could be a really, really good buy over the next. It's tricky over the next month or so. There should be really good spots to buy these and trade them, kind of swing trade them through this cycle and possibly go long, and then at the end of the cycle. And then there's another trick here, like the STNG. There's crude fleets. Scorpio is STNG, and those are product tankers. It's like refined oil. And now the product tankers, there's enough oil oversupply that the product tankers are being used to store crude. So now the product tanker fleets are getting the huge bump that all these crude fleets got early on. And there's Ardmore. Oh, what's Ardmore? I think it's ADC. Might have to double check that one, but it's Ardmore. And there's Top Ships. Just looks really bad, but it's another crude fleet that's interesting. And PXS is a Greek fleet that is Pyxis or something. I don't know how to pronounce that thing. There's a bunch of these crude fleets that are just getting really interesting right now to see if they're going to be storing crude or not over just maybe the next 1 month or something. They might get a really big bump for a month and kind of a swing trading idea. Or Tsakos fleet, which it's TNP, Tsakos Navigation, whatever it is, PLC or something. Tsakos is another Greek fleet that is some product tankers and crude. So these are the product tanker fleets that I've been looking at to see if I think those are going to get a bigger bump than the crudes, because the crude fleets have already gotten full storage. They're all parked at off of California, off Texas, off China, Hong Kong, off Singapore. All these fleets are full of oil already, and they're just waiting for the oil price to come back up, and they'll start unloading when the oil price gets high enough. but it's not high enough yet, I don't think, for them to start even unloading what they have now. And so the oil supply that's being created now is going to go onto these product fleets, and you'll see these product fleets get a bump like you saw these ones get earlier the previous month or so. And yeah, that's kind of the look at them. There's a couple other fleets. I've been doing a ton of videos on these oil tanker fleets, and I think this is the two ways really to go long on oil right now, is to do this shorting the SCO inverse oil fund is just a really cool way to go long on oil for just the short term, because it's really only like a 2-month outlook when oil is going to be increasing, and these fleets are just really, really good in this credit contraction cycle. It's just one of the very few businesses that is doing well in the credit contraction cycle. Like, they're up over the whole cycle while everything else on earth is down. These guys have been up, and they're coming down a little bit now, and they should come down. If the oil prices come down and we get a contraction, we might get a really good spot to go in on some oil tankers, either the crude or the product fleets. And then the oil companies, I guess, like Exxon and Chevron and Royal Dutch Shell. I think Chevron right now, Chevron is high. It's too high. So I was looking at Chevron as a short for this week to see if it comes down with the contraction and see if there's a little oil crash. Just over the next week or two to see what kind of contraction we get and what kind of oil price activity we get with the future contract rollovers and the contango, all that stuff. But I think at the end of this cycle, probably in June sometime, it'll switch from this credit contraction where none of the companies have enough money and they can't pay the loans into an expansion where people have money again and businesses can grow. And that is when I think the oil companies, well, we'll see which ones are still looking good, but the big oil companies like Chevron, Exxon, Mobil, Total, all those ones those should be at low points, reversing into a positive expansion where energy sector in general should be good, but just coming off of oil low prices into increasing price, just the entire thing should be a really good outlook for a bunch of companies. And I think the oil tankers should still be good. Like, the crude tankers should still be good. The product tankers will be less interesting as time goes on because they'll switch back to doing product. And the crude tankers will still be storing crude probably till like September. So I have a few month outlook on the crude tankers, and I have some sneaky swing trade ideas here on the product tankers just over the rest of the cycle. And then at the end of this cycle, normal oil companies probably will be a really good long, or just energy sector kind of stuff in general. So that's a big look at oil and actually how to go long on oil, which I have been trying to figure out how to go long on oil. And all these oil funds are just not a good option for going long on oil because there's future contracts and compounding and contango. It just keeps them from making money. They just don't go up. So shorting this, there is, there's your upside. It's a levered 2x that dives. It dives off peaks down to stable lows, and you can just short this thing right down to a good oil price, and then sell those contracts off. And this is not investment advice, and I don't know if I said all the like button stuff and the subscribe button and whatever. So yeah, okay, I think that's about it for the oil. If you have any questions on contracts, like options contracts trading, or on futures contracts and how the spot oil price is relating to the futures prices and that kind of stuff, and the outlook on the oil price to the end of the year. I don't know if I really believe the projections, just because I just don't know. I guess I don't know what Russia's really going to do. Russia's kind of at the middle of this oil situation, where they are. Well, they're building a pipeline, the Nord Stream 2 pipeline from Russia to Germany right now, against sanctions, against U.S. sanctions, against UN sanctions. They're just like, whatever, we're going to build this thing. And they've asked to have sanctions removed several times throughout this oil crisis, and UN and countries in Europe and the U.S. have said no immediately. And so Russia's just like, all right, well, if we have the ability to hold these oil prices down if we want to, and we could do it for like 10 years. So they're negotiating, they're using the oil as a negotiation, and the oversupply is decreasing and the prices are increasing, but it still is a big oversupply and there's still low prices. And those prices are looking to go down again towards the end of the year. It's not looking to go up and up and up from here. So it's gonna be weird over the next year to see really how this happens. And yeah, this credit contraction and low oil prices is just devastating to the American fracking and oil exploration companies, because they're not profitable at these oil prices. And Russia is building a natural gas pipeline, so like the natural gas that America would make with the fracking industry, like Russia can do that way cheaper and completely undercut everybody and press the oil prices down, and then they can transport oil, on these new pipelines, and it's natural gas pipelines. So that's what's happening in the international stage, and kind of politically what might be affecting oil over the next year. But just looking at the stock charts, I mean, these are low prices. I don't know how low oil can really go. I don't think we're ready to switch into completely different energy like at the moment. Like there might be a switch to renewables and stuff like that, or more coal energy. Uranium is a big thing. So there's a bunch of energy looks actually kind of over the next year. There might be really, really good value buys in like coal or uranium, or even like the coal that's used for energy. Like not all the coal's for energy. Like the metallurgical coal that's used to make steel, like that'll be around a long time, and those are at historically low prices. So metallurgical coal might be a really, really cool commodity value investment purchase. So there's a bunch of energy ideas relative to oil staying down, where other energy might come up, and you get sort of deglobalization, and you might have certain countries getting really big into uranium or something like that. So there might be like specific uranium companies related to different countries that might get interesting. We'll have to see. We'll have to see what happens here. It's definitely interesting, and there's definitely some drama going on with the dollar and the oil and the petrodollar and all the stuff. So that's the oil outlook for today, and happy trading.